Hey everyone, and welcome back to Your Money, Your Life podcast, episode 201 of the podcast. That is episode 201. Before we get into it, make sure wherever you're listening, go like, subscribe, 5-star rate, and review the podcast. If you're watching on YouTube, make sure you hit the notification bell so you know every time we drop a new episode, as we are doing right this second. Let's get into it. The first and foremost, we always try to start by going over what's been going on for the week in the market. Pretty good week. I'll say it was roughly, we're up about 0.5% up so far. The last month has been pretty strong for the market, even the last, relatively speaking, 6 months. But it's really October, end of October is where we saw this resurgence in the stock market, getting back to all-time highs roughly. We're closing in on that, on our all-time highs from a bit ago. So again, this resurgence happened, and there's a couple of reasons why. The main reason, if you look here, being that the market is trying to take into account the new earnings report we had and jobs report we had. Those are some of the three, the market indicators right now that are pushing the market a little bit higher. Basically, we also saw Google, Alphabet parent, shares of Google parent Alphabet gaining 5% today off the launch of their Gemini artificial intelligence model. But so that's pulling the market higher a little bit respectively. But a lot of this has been focused on weekless jobless claims, which came in a lot lower. The weekly jobless claims came in a lot higher than expected. And they were actually below the economic expectation. So their reading of the continuous jobless claims declined, indicating that the pace of layoffs hasn't increased. So a couple things going on with there. There's a private payroll data that came out Wednesday that showed employers added fewer positions than economists forecasted. So that's that private payroll data showing, how many positions are being added to the economy, how much more production, jobs. And so traders are looking at this picture saying that we're having inflation go down. The job market's still strong, but it's showing signs of cracking, and the consumer and demand is also showing signs of cracking. What does that mean? Are we going to potentially see rate cuts? Some banks and some research companies are starting to show rate cuts as much as 6 times in next year, which I don't foresee. I think we're just going to have rates stay higher for longer. They're going to stay where they're at for a bit longer. And I think the Fed, Jerome Powell and the Fed chair and the Fed, they want to see a crack in unemployment, and they want to see a crack in the housing market before they feel comfortable bringing rates down. Because right now, what's driving rates is pretty much, what's driving CPI is pretty much oil prices. Oil prices is probably one of the main components driving CPI. So as you see here, again, that October low, a huge bounce back from then. Again, that's what people don't understand about the market. I've always said, you don't just try to invest for short terms, you try to hold for longer terms, you try to do smart considerations for longer, because people start complaining and start not understanding that part of the market is ebbs and flows, and they start complaining around October. They're not understanding what's going on. But if they just listen, wait, use patience, and have a longer time frame horizon, and maybe people don't, and that's just, again, not what New Street does. We have a longer time horizon, which, if you've been investing, in a sense, for with us, or like, you're just seeing what longer time horizon does. Here's a 5-year time chart showing what the bottom of the pandemic to where we are now. So that's one thing to note. What's going on. I want to touch on cryptocurrency as well. So we're seeing a resurgence in cryptocurrency, and a lot of that, again, it's driven by a few things. One of the things is the ETF approval that is coming down the pipeline for Bitcoin. The more likely the ETF approval that will come down the pipeline for ETH. So a lot of people, again, that's what goes back to that long-term thinking. A lot of people I've seen people pretty much get rid of their Bitcoin, do all these different things. We always have a longer time horizon for these things. And I always said, have a smaller percent allocation into your cryptocurrency. We even started doing that for clients in sense of managing their cryptocurrency. Recently, Gemini made the decision to stop allowing advisors to manage cryptocurrency for folks on their platform. So we're actively evaluating other platforms, but we told folks to hold on because this is a longer term play. There's a limited supply, all these different things we talked about, the technology, all these different things. But we just have to hold on. It's a longer term play. I was one of those people that held on. I didn't sell any of my cryptocurrency. And you don't need to sell for people that don't need cash. You don't need to sell if you have a long term horizon. So I didn't sell any of my personal cryptocurrency or any of those things. But if you're looking year to date, there's been a strong resurgence over a 1 year time frame, over 100x%. So now trending at 43,000, a little bit above 43,000 versus the depths that it was, you know, pretty much at the end of, if we look at 2022 in October, in November, sitting around 16,000, and now pushing forward to 43. So again, people that don't, they that's why, again, traders and people that want to do stuff themselves, they lack a lot of this fundamental analysis to understand, sometimes looking at things from a little bit different lens. So that's something to watch out for as well. We'll go to current events so far. I looked at this and saw it was interesting. So Shein, I think, is looking to go public. That's a clothes retailer, and they do different stuff as well. It's a fashion giant, China-based fashion giant. That's Shein. And Amazon, of course, competes with Shein and other retailers and fashion giants and any sort of people that are selling anything, because Amazon pretty much sells anything. But Amazon is going to cut their seller fees for clothing priced under $20. So Shein is that fast fashion. I mean, it's like people debate how it's actually produced because they're selling things for so cheap. But selling things for cheap, they're cutting their seller fees on Shein. Their seller fees are low because they're selling things for cheap, producing for cheap, all this stuff. It's all about low and price and cut low margins. But Amazon, of course, wants those higher margins. But to compete with Shein, they're lowering their seller fees for clothes priced under $20. It's a move to fight against fast fashion giant Shein. So beginning in January, seller fees on clothing cheaper than $15 will drop to 5%, and items priced from $15 to $20 will drop to 10%. Both fees used to be 17%. And Shein shifted its focus this summer from its branded apparel to Amazon-like online marketplace, using third-party vendors to sell a variety of products. So they're going after Amazon by saying, hey, we're not just going to focus on fashion. We're going to sell a variety of products through third-party vendors. And so Amazon's taking a strike back, and realizing that Shein and these other companies, and Shein's one of those companies that's going to IPO soon, are looking to cut into their own margins. Speaking of another tech giant, Alphabet, Google, they launched their Gemini AI model. So they said it's the most advanced version of a newly launched AI model. Gemini Ultra is able to outperform human experts on certain tests. Google made what they thought was a substantial leap forward in the artificial intelligence rates Wednesday. The market seemed to like it as well. If you're on YouTube with us, the market liked it as well. On the NASDAQ, I think as of this morning, again, we're recording on Thursday morning, we were up almost 5% on the day. They were up 5% on the day. So again, the market cheering it. And then there's a kind of a big jump today based on this news of their new language AI model, Gemini. They're saying it's it's most capable. It's developed using Google's own AI chips. It can process information from video, text, image, and audio sources, and is capable of complex reasoning and grasping nuance. Oh, okay. Okay, they're saying that these things are going to be as advanced as us in 5 to 10 years. And this is pretty much showing that these generative AI models are actually catching up to humans. So if you're doing a job that a computer can do, watch out. These are now starting to be as sound and nuanced as a human being. That's getting to scary territory, was. But the market liked it. And I was on a CNBC show months back, and I said that I think Google wins this AI race, and one of the winners of this AI race is, if you're looking at it from the three tech giants like Microsoft, Apple, Google's winning. NVIDIA is another winner in the sense of their chips, and so they're winning. They're up there. It's going to be a race, and people are choosing their bets. Another large company that is doing something different than growing, McKinsey, which obviously is a big audit and consulting firm, they're lowering their partner class. So if you know these companies, they usually have, it's a pyramid, right? It's a structure. There's a bunch of associates that start, and associates maybe move to like vice presidents. I don't know how they do it in consulting. It's different. It's similar to like what they did in investment banking. And then from there, they go from VP to director, and then director to managing director, which would be similar to a partner in a McKinsey or a consulting firm. So their things are getting harder at the top. The newest class of partners at McKinsey and Company is just 250 names long. The Wall Street Journal reports that's a 35% from last year's class of 380 new partners, and a 40% decrease from the 420 who landed the coveted promotion in 2021. So it's getting harder. That means they feel like there's not going to be enough work to go around, because a partner, as a sense, is finding new business, finding new clientele, managing the current clientele they have, and that's what they do. But it sounds like it's tough time for consulting. I mean, they're cutting the partner class, which again, the partners get paid the most, and they're supposed to generate new business, at least, and as well manage current business. And they just cut the class. So people are saying, is it the sign of the times that demand is shrinking? Of course, companies call on consultants when they need things done. Consultants bill them heavily for their hours, and maybe their companies are pulling back on their consulting fees. So that's something to watch out for. And for us, and a lot of people are thinking that's a bellwether of what's to come. But we'll have to watch that really, really closely to see if it is. Uber is going to join the S&P 500. This is after a banner year for the Uber, but yeah, they're looking to join. They're on the crest, the cusp of joining. It's after the benchmark for the broader market. Of course, the S&P 500 is. Companies joining the S&P club may sometimes see a temporary stock boost. Sometimes, again, you never know, because their addition can drive buying from fund managers that are buying the S&P. Of course, they have to buy a piece of what's in the S&P. So roughly a third of S&P companies have been replaced since 2015, and 11 companies have been added this year, including Airbnb and Lululemon. I definitely think Uber should be in S&P 500. Their market cap broke 100 billion last month, and that's the second time ever. It's now sitting at roughly $119 billion valuation. It makes sense for them to be in the running or in the S&P 500. It just makes total sense. Yeah, I think, one thing we'll talk about in our roundtable, folks, is we get to the roundtable, is just the overall thought process as you end the year, right? Like, you could be tired, exhausted, hit your goals and not hit your goals. But as we end the year, we're almost there. What are you planning to do for the rest of the several months that you have? I don't think it's a thing where you have to put your pressure on yourself to try to accomplish everything that you couldn't or haven't yet in this year that you're esteemed to do. But I do think it's good for us to see if we can push harder for everyone that's out there. I know it's exhausting in Q4. Everyone's pushing things to Q1. Everyone's tired. Everyone's got holiday family plans, but just stay focused on our goals. Stay focused on our goals. We're all in this together. We've been speaking on this platform for months. You guys have been listening for years and months, especially for new listeners or old. But one thing, we set goals out for 2023. Whether you accomplish it or not, you still have plenty of time left in this month to get to everything you want. And then you can celebrate at the end of the year. Celebration is also part of this. Review, setting goals for next year is all part of this. So let's make sure we do that. We finish strong. We do all the things we want to do so we can help ourselves and our family out. We will be doing another personal finance webinar for women end of this month to kick off the new year. We'll be sending out to several select clients to forward those people in their network. If you know people, especially women that are either creative, self-employed, 9-to-5ers that want help in this area, make sure they tap in with us and we'll get them all set up. Folks, this is another fun episode. We will make sure to stay doing our thing, and we will talk to you next week.